Hi viewers, welcome back to my channel. Today's video is on the reflection of few phone calls I received over the weekend, and few friends and viewers, they called me and they shared their experience with me, and they told me they used to invest in the stock market and they had very bad experience. And I asked them what happened, what's the bad experience. Then they told me, I used to invest in stocks, and initially the business was doing very well, but all of a sudden the business didn't do very well, and then the share price has dropped and they lost all of their investment. Then it made me to think, what did went wrong? So then I realized, yes, because they didn't have proper knowledge how to diversify their portfolio, and because they only invested in one business and they lost all of it. So today I will explain exactly how you can prevent from yourself from this sort of risk and prevent this happening in your portfolio, in your investment. So before I do that, I have a small request for you guys. Please subscribe my channel and share with your friends, so whoever wanted to invest, they can be benefited. So let's get back to the topic, how you can successfully diversify your portfolio. What is diversified means? Diversified means you divided your investment into few businesses rather than only one business. So there is a common saying you all know, no matter how shiny the basket is, never put all of your eggs in one basket. So when you put in one basket, then you risk yourself too much. If anything goes wrong with the basket and anything wrong goes with the business, you'll be losing all of your money. So rather than investing in one business, you're going to invest in few businesses, so that even whatever business you invest in, even one business go down, you will have another businesses to rely on, so you don't have much effect on portfolio. So the good side is you minimizing the risk. The flipping side of this, obviously, let's say one of business you invested that went up 10 times high, and obviously you're not going to full benefit of it. But on the contrary, you minimizing your risk. Even if the business goes down, you have other three to rely on, so you don't lose much. How can you successfully diversify your portfolio? There is 4 rules, basic rules you have to follow to diversify your portfolio. You diversify your portfolio adequately, not overly. If you diversify too much, the return on your investment will be low, but if you do too low, then your risk will be high. So you just have to find the right balance, where to balance it. So to balance it depends how much you invest in. So on the amount of investment, you can diversify your portfolio from 10 to 30 companies. The second thing you have to do, you have to make sure that each business you choose, they are prominent business and they have financed their business carefully. And third thing you have to do, you have to check on their dividend track record, how much they pay dividend and how reliable they are in terms of paying the dividends. The fourth thing you have to do, you have to set up a price, in which price you wanted to buy the stock. So you don't want to buy it in overpriced. How can you do that? You check on the PE ratio. If you check in any companies within 1 to 7 years, PE ratio, price to earning ratio, you'll be paying up to 20 times. If you check in only for 1 year, you can consider up to 25 times. So these are the 4 basic rules to diversify your portfolio. You can diversify your portfolio in terms of companies, you can diversify your portfolio in terms of market, you can diversify your portfolio in terms of industry as well. For company wise, rather than choosing on one company, same market, let's say EV market, you wanted to invest in EV market, then you would choose 2 companies rather than choosing one company. For example, you can choose Tesla or Nikola. So let's say, for example, Tesla did very well, then you will be benefited, and Nikola didn't do very well, then obviously you can balance it out. So even though you may not have good return on Nikola, but you have Tesla. You can diversify your portfolio in terms of industry. What sort of industry? Let's say there is healthcare industry, there is tech industry. For example, when pandemic happened, all the healthcare business went up and the tech companies went down. So if you would have invested in 2 industries rather than only one industry, then obviously your portfolio wouldn't be affected too much. You will have healthcare industry to rely on those hard days. I will show you a exactly real life example when you diversify your portfolio, how it will look like. So let's have a look into it. This is your whole 100% portfolio. Out of your 100%, what you do, let's say you choose automobile industry. In automobile industry, so rather than investing your money into one company, you can invest into 2 companies. Let's say, for example, Tesla and Nikola, as you can see in here. The percentage will vary upon you how much you want to invest on which company. And let's say you invest in utilities company, so rather than investing in one company, you can invest in two companies, for example SSE and Iberdrola. This is two utilities company who provides electricity and gas and electricity in UK. For example, you want to invest in airline industry, then rather than investing in one business, you can diversify into two business in Delta and Southwest. So in real life, when you diversify your portfolio, it will look something like this. I hope this is clear.